Artificial intelligence has become a powerhouse in today's world, driving innovation across industries. With the AI market expected to reach $2 trillion by 2030, many investors are eager to tap into this growth. One of the simplest ways to invest in AI is through exchange-traded funds. But with a lot of AI ETFs on the market, choosing the right one can be overwhelming. In this video, we'll explore some of the best AI ETFs to consider for your portfolio, taking factors like investment focus, performance, and expense ratios into account. Let's dive in. Number 1. iShares US Tech Breakthrough Multi-Sector ETF. One of the best ETFs to invest your money in is the iShares US Tech Breakthrough Multi-Sector ETF. This ETF focuses on US companies that are leading technological innovations across various fields such as robotics, AI, cloud computing, cybersecurity, finance, and genomics. By investing in this ETF, you get exposure to a wide range of companies that are expected to benefit significantly from advancements in AI and other technologies. The iShares US Tech Breakthrough Multi-Sector ETF has performed well with a year-to-date performance of 21.7%. This means that if you had invested in this ETF at the beginning of the year, your investment would have grown by 21.7% so far. The ETF holds a total of 184 companies in its portfolio, providing a well-diversified investment option. Diversification is important because it spreads your investment across many companies, reducing the risk if any single company doesn't perform well. Additionally, this ETF has an expense ratio of 0.4%. The expense ratio is the annual fee that the ETF charges investors, and at 0.4% it's pleasantly below average. This means you keep more of your returns rather than paying high fees. With its good performance, diversification, and low fees, it offers a smart way to invest in the future of technology. Number 2. iShares Global Tech ETF. The iShares Global Tech ETF is another excellent investment option, especially for those interested in the technology sector. This ETF has a significant portion of its holdings in tech giants like Apple and Microsoft, which are major players in the industry. However, it doesn't stop there. The ETF also includes key stocks like ASML Holdings and Taiwan Semiconductor. These companies are crucial for the growth of AI and other advanced technologies. The ETF has performed impressively, with a year-to-date performance of 23.7%. This indicates that if you had invested in this ETF at the start of the year, your investment would have grown by 23.7% so far. It holds a diverse portfolio of 114 companies, providing a good balance and spreading the risk across various tech sectors. This diversification is important as it mitigates the risk associated with any single company's performance. The expense ratio for the iShares Global Tech ETF is 0.4%, which is quite reasonable. This fee is relatively low compared to many other ETFs, meaning that you get to keep more of your investment returns rather than paying out fees. Through its good performance, diversification, and low fees, iShares Global Tech ETF is a great option to invest in the future of technology and AI. Number 3. iShares US Technology ETF. The iShares US Technology ETF is a foundational investment option for those interested in the AI sector. This ETF includes top holdings such as Microsoft, Alphabet, Nvidia, and Meta. These companies are leaders in AI technology, driving innovation and growth in the industry. The ETF has shown impressive performance with a year-to-date return of 29.3%. This means that if you had invested in this ETF at the beginning of the year, your investment would have increased by 29.3%. It holds a diversified portfolio of 139 companies, providing broad exposure to the tech sector and spreading the risk across multiple companies. One of the advantages of the iShares US Technology ETF is its low expense ratio of 0.39%. This fee is relatively low compared to other ETFs, which means you get to keep more of your returns rather than paying high management fees. It offers an excellent opportunity for investors to gain exposure to leading companies in the AI space. If you're enjoying this video, hit that like button, subscribe, and turn on notifications for more valuable content. Number 4. Invesco Semiconductors. The Invesco Semiconductors ETF, with a ticker symbol PSI, focuses on investing in the semiconductor industry. Semiconductors are essential components in all electronic devices, including computers, phones, and many other gadgets. PSI offers a way to invest in this crucial sector, which is at the heart of modern technology. Among its holdings, PSI includes top players in the semiconductor industry such as Nvidia, AMD, and Micron. In terms of performance, PSI has delivered solid returns over the past 5 years. This indicates that it has been a strong performer in the semiconductor sector. Additionally, PSI pays a small dividend to its investors, providing some income along with potential growth. However, it's important to note that PSI has a somewhat high expense ratio, meaning that the costs of managing the ETF are higher than average. The focus on small and medium cap companies can lead to significant performance swings. In its best years, PSI has achieved impressive gains, but it can also experience substantial declines in its worst years. This volatility is a trade-off for the potential high returns these smaller companies can offer. Number 5. Invesco QQQ Trust Series 1 ETF. The Invesco QQQ Trust Series 1 ETF is a highly regarded investment option that focuses on high-tech companies with strong growth potential in artificial intelligence. This ETF is known for its solid performance track record and reliability. One of the standout features of the Invesco QQQ Trust Series 1 ETF is its low expense ratio of 0.2%. This means investors can enjoy higher returns since a smaller portion of their investment goes towards management fees compared to other ETFs. With a year-to-date performance of 23.8%, this ETF has demonstrated robust growth. If you had invested in this ETF at the beginning of the year, your investment would have increased by 23.8%. The ETF holds a diverse portfolio of 102 companies, providing exposure to a broad range of high-tech firms that are at the forefront of AI development and innovation. It's an attractive option for investors seeking to capitalize on the growth potential of high-tech companies. Number 6. First Trust Nasdaq Artificial Intelligence and Robotics ETF. The First Trust Nasdaq Artificial Intelligence and Robotics ETF is an investment option that focuses on a wide range of companies, including some leading defense companies. This ETF is unique because it includes sectors that are not typically covered by other ETFs, giving investors a chance to diversify their investments differently. With a year-to-date performance of 14.2%, this ETF has shown steady growth. The ETF includes a total of 113 different companies, providing a broad range of investments within the artificial intelligence and robotics sectors. However, there are some things to consider before investing in this ETF. It has an expense ratio of 0.65%, which is higher than some other ETFs. This means that a larger portion of your investment goes towards management fees, which can slightly reduce your overall returns. Another factor to consider is the ETF's exposure to defense companies. While these companies can offer significant growth potential, investing in them might not align with everyone's personal values or investment preferences. Additionally, the inclusion of defense companies can introduce a higher level of risk due to the nature of the industry and its dependency on government contracts and geopolitical factors. Number 7. QRAFT AI ETF. The QRAFT AI Enhanced US Large Cap Momentum ETF, known by its ticker symbol AMOM, stands out from the other ETFs. This fund uses an advanced AI model to select its investments. The AI relies on a historical algorithm to identify high-performing stocks, and it ensures that no single stock makes up more than 10% of the fund's total holdings. This balanced approach helps in managing risk and maintaining diversification. When you look at the AMOM's top 10 holdings, you'll see major companies like Apple and Microsoft. In terms of performance, AMOM has shown good results. However, when comparing its 3-year performance to other ETFs, it ranks on the lower end. This suggests that while the fund is doing well, it hasn't achieved the highest returns compared to some other options. One thing to be aware of with AMOM is its expense ratio. It's the highest among the ETFs discussed today. The expense ratio represents the cost of managing the fund, and a higher ratio means more of your investment goes towards these fees, potentially reducing your overall returns. Despite the higher expense ratio, AMOM's use of AI for selecting stocks makes it an innovative choice for investors. Number 8. iShares Robotics and Artificial Intelligence ETF. Finally, the iShares Robotics and Artificial Intelligence ETF, known as IRBO, is designed to give investors access to the rapidly growing AI industry. It tracks the NYSE FactSet Global Robotics and Artificial Intelligence Index. This index includes companies from around the world that are leaders in AI, robotics, and automation. IRBO was formed in 2018 and currently manages less than $1 billion in assets. Despite its relatively small size, it offers a well-diversified portfolio with 133 different company holdings. This diversity means that investors are not putting all their eggs in one basket, but are spreading the investments across a broad range of companies. One of the standout features of IRBO is its focus on fast-growing small-cap companies. These are smaller firms with significant growth potential, which can provide high returns. The ETF includes companies involved in various sectors such as industrial automation, healthcare technology, and electronic manufacturing. Notable companies in its portfolio include ABB Limited, Siemens, and Yaskawa Electric, which are known for their innovation and leadership in robotics and AI. Another important aspect to consider is IRBO's expense ratio, which is 0.47%. This is competitive and ensures that a relatively small portion of your investment goes towards management fees, allowing more of your money to work for you. It's worth noting that IRBO has a higher exposure to cloud stocks and chip makers compared to pure AI companies. This means that its performance is not only tied to the advancements in AI and robotics, but also to the overall health and performance of the cloud computing market. This broader exposure can be a double-edged sword, providing additional growth opportunities but also increasing susceptibility to market fluctuations in these sectors. Investing in AI can be a wise choice considering its rapid growth and technological advancements. The AI ETFs we've discussed offer a range of options, from diversified portfolios to focused sector exposure. Whether you're seeking high growth potential or a more conservative approach, there's an AI ETF suited to your investment goals. Remember to research thoroughly and consider consulting a financial advisor before making any major investment decisions. Which ETF piqued your interest? Share your thoughts below in the comments section. And don't forget to like and subscribe for more valuable content. Thanks for watching.